Today we will discuss about financial statements. Financial statements help managers and investors track the financial results of an organization's activities. Primary financial statements are balance sheet, income statement, and statement of cash flow. First, we will discuss about the balance sheet. Balance sheet is a financial statement showing the resources owned, the debts owed, and the owner's share of a company at a given point of time. Balance sheet is also called the snapshot of the company's financial position because it is a static view of financial value or net worth at a point. The accounting equation which is showing the balance sheet is assets are equal to liabilities plus owner's equity. An organization uses investment from owners and amounts owed to others to acquire assets that are expected to generate a positive or negative return. The balance sheet shows the increase or decrease in assets, liabilities, and owner's equity from year to year. There are many purposes of balance sheet. One purpose of the balance sheet is to show whether the organization has increased or decreased during the year. This is done by comparing the current year's amounts to the amounts in prior years. Second one is the balance sheet can also be used for a number of financial measurements. For example, success of supply chain activities as it shows accounts receivables and accounts payable. Now we will discuss about a balance sheet by showing an example. Sample of balance sheet showing 2 years of results. Here we can see assets, liabilities and equity is shown. Assets includes two types, current assets and fixed assets. The assets which are expected to be converted to cash within 1 year are called current assets, which includes cash and cash equivalents, inventory, prepaid expenses and accounts receivable. Fixed assets are long-term assets not easily converted to cash, which include gross property, plant, equipment, less accumulated depreciation, and these both conclude the total assets. Then are the liabilities. Liabilities also are two types, current liabilities and long-term liabilities. The same current liabilities are amounts owed this year which we have to pay this year. And long-term liabilities are amounts which we have to pay beyond 1 year. Then is owner's equity, funds from owners and operations, with what is left after liabilities are deducted. Then is the owner's equity is what owners have contributed, which include common stock or additional paid in capital. Then is retained earning. Retained earning is reinvested funds from operations. Now here you can see that total assets is equal to total liabilities plus total equity of both year. Next we will go for income statement. Income statement is a financial statement showing the net income over a given period of time. The income statement shows managers, investors and creditors whether the company has made or lost money during the given period of time. Income statement is based on the equation income is equal to revenues minus expenses. Income statement can be used to see the profit and loss of a company, can also use to determine effect of supply chain expenses over net income by reducing the direct material expenses, it directly increases the profit. Now we will elaborate it. So now we will elaborate income statement by giving an example. Income statement is profit or loss over a given period of time. First we will write revenues, which directly comes from sale, and we will minus from it cost of goods sold, which is direct labor, direct materials and factory overhead. Revenues minus cost of goods sold give us gross profit. Then we will minus operating expenses, which are selling expenses, general and administrative expenses, and lease expense. General expenses are which are used from running business that cannot be directly linked to specific units of goods or services sold. Then we will less depreciation, interest expense, and here we will get net income before taxes. Then we will less income taxes and we will get net income, which is net profit. Here we can also see the effect of taxes on profit, and we can see income percentage against revenue. Next one is statement of cash flow. A financial statement showing the flow of cash and its timings into and out of an organization is called statement of cash flow. The statement of cash flow shows the sources of a company, cash flow, and how these cash flows are used. The net flow of money into or out of the proposed project in any time period of all cash receipts, expenses, and investment. Being able to read and understand a cash flow statement is important because it enables us to assess generating enough cash to fulfill its minimum obligations to lenders, investors, and government, generating extra cash that can be used to repay debt, purchase additional assets for growth, or invest in new products. So now we will elaborate it by giving an example. Change in cash balance over a period of time, like end of year ending December 31. There are three sections: operating section, investment section, and financing section. In operating section, we will add depreciation back, increase or decrease in inventory, increase or decrease in accounts receivable, increase or decrease in accounts payable. Increase in inventory lessen the cash. Increase in accounts receivable will decrease the cash. An increase in accounts payable will increase the cash. Then comes the investment section. We will lessen the capital expenditure. Then comes the financial section. Additional equity. We will less the dividend paid. Increase or decrease in long-term debt. Increase or decrease in short-term notes. We will get the cash flow from operations, investment, and financing. Then we will add the beginning cash in it, and we will get ending cash balance. We will also compare it in 2 years, like in 2014 it was 783 million, and in 2015 it is 907 million. So it was all about the financial statements: income statement, balance sheet, and cash flow statement. Thank you.